Episode 184 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudele sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudele.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. So without further ado, let's dial into those top moments of the show this month. So Phil, what are you seeing in the charts and in the fundamentals right now here in crude oil?
So yeah, if you look at, so again, we're going to line up with the technicals on the crude oil market first. We see this thing has been in a bull market for quite a long time here. If you look at the last 3 months, the performance of crude oil or any commodity out there, the best performing commodities have been crude oil, the Brent crude, and then West Texas. You've got them up north of 20%. Each market. So crude oil has been an incredible bull market. You've got the stochastics are in that overbought territory, confirming it's in a bull trend. MACD's straight up. The couple things that on the technicals that are slight flags out there is that ADX has leveled off and started to come down a bit. So that tells you that the trend is slightly weakening. And then also the average true range is getting a lot smaller. It's closer to 80 cents rather than that $1.50, $2 range we were seeing back when the bull market was real strong. So as a result of that, it tells you that the traders are really in a tug of war on whether or not this market should continue to go up. And so if I was long crude oil for quite a long time, I'd be a little bit cautious up at these levels.
So you talked about some of the technical signs out there saying that it could be leveling off. Now, at what point in those charts that you're looking at would you then turn bearish? And also, if you could, comment on anything that you're seeing fundamentally right now that we should be keeping an eye on.
So if you start off with what would be, a line in the sand for the bearishness, price-wise, really if we cross below some of the, so we've had like a flagpole, we've had this rally up for a while, and now we're starting to have a flag formation, and the market's in this kind of low to mid 60s, 65. Really, if we break below like $62, I would start looking at, hey, this thing might be, the floodgates might start be opening. And if you go to the story that's on crude oil, the reason why this thing, had really rallied there, we did see a little bit of a pickup in the demand. The U.S. economy has been pretty good. China's been heating up a bit. It seems like Europe's leveling out. So, that story's there. And then the other big story is OPEC. Now, if you rewind back, OPEC for years, they've been trying to curb production levels and drive prices higher. This is especially since oil prices had, peaked at, north of $120, $130, and we had sold all the way off below 40 and into the 30s. That really jolted and gyrated a lot of these different countries, especially OPEC, that they only rely heavily on oil and oil exports in order to balance their budgets for the entire country. So OPEC came out and they pretty much said, we need to curb this production. And they finally get compliance from the 14 nations that are out there. They curb production levels across the board. There was only one or two countries that were allowed to go above the production, like war-torn countries like Iraq. They could kind of produce whatever they want to. But So once they start getting that compliance involved and prices start coming up, the countries start to look to do better. And what they did was they reached out to 10 other allies that are out there, and they said that, we need to continue to support these prices. Can you guys come out and help curb the production? And that's exactly what happened. So prices have taken off. I think that's the most bullish fundamental that's out there. However, if you start to look at that chart pattern, you're seeing that prices, the ADX has been weakening the strength of that strong trending market up. It's starting to weaken off. Prices have failed to make a new contract high recently. And as a result of that, I think that this cooperation, it may have, it may have kind of overdone itself where these guys have cooperated too long, and now countries are going to look, hey, we're all back in the black. I know U.S. shale producers, they're back in the black, and everyone, it's going to start to go into the every man for himself type phase. So you should start to see compliance unfold. Countries like Russia continue to expand their production. And then also U.S. shale producers, I would anticipate that the U.S. breaks through that 10 million barrel per day mark, and we start to see production levels skyrocket. Therefore, the price of crude oil should start to level off and come down in the next couple months.
Tracy, you wrote a post the other day about explaining the correlation between the euro, US dollar, and WTI crude oil. Can you talk to us a little bit about that?
All right. So people had asked me about it because they were noticing that basically they were ticking together. So this is not a new correlation. Obviously nothing's correlated 100% all of the time. However, since the euro came about, basically, this correlation has been, and I posted some charts, and I'll repost the charts, but the exchange rate, the dollar-euro exchange rate, has followed crude oil. It's one of the best correlations out there that there is as far as correlations can go. And part of this reason is that oil exporting countries, especially in Europe, they trade their assets in dollars, right? Oil sold in USD mostly. But what happens is that as the price of oil increases, you do have an increase in their foreign exchange reserves. So part of their foreign exchange reserves, they take those dollars and they buy euros because they're selling primarily to the Eurozone. So when the price of oil goes up and their foreign exchange reserves increase, then more of their purchases can go towards purchasing the euro. Conversely, when the price of oil goes down, foreign exchange reserves decrease, and they buy, less dollars are transferred into the euro.
So before we get to Ira, what do you do with these correlations, and how do they help you with your trading?
Well, I trade oil and the euro a lot. So knowing these correlations, I can watch positioning, and if you notice, if you look at like COT data, you have as oil longs increase, we had kind of the same thing happening in euro at the same time. So I watched that data because they do kind of move in tandem. And so that's kind of the approach that I would use towards trading both oil and currency. If I saw something flip in one, say massively flip short or something like that, we saw, a huge change in the data, and I would probably look for the other to follow.
I want to talk about something that I trade a lot more these days than I did in the past, and that's the bond and treasury market. Now, it's been consistently trading weak for the past few months, and I've been noticing on my strategy that these short alerts I've been getting, they've been working really, really well. But I like to have confirmations, Ira. You and I talk about this all the time. I love to see what's happening in the dollar, what's happening in the gold markets, and seeing a weak bond and treasury market with a strong gold market. I'm getting buy signals in gold and sell signals in treasuries, which I don't like. And I'm looking at the dollar just getting destroyed to the downside. I'm looking at this going, this is odd. And it's one of those things where I never really ask why something is happening, but I'm confused at what's going on here. So I want to know, what do you think about this trade that we're seeing right now with weak dollar, weak bond and treasuries, and strong gold?
This is the big question out there. Forget about the bonds. Bond and gold have a correlation. I'm using the 30 years because I've kept that chart for 35 years, only because they have an inverse correlation together based on total psychology of the marketplace. Because there's no rationale to a 30-year bond. I don't care what any economics text tells me. 30 years, I can't tell you what's going to be in 30 days with any real certainty. So 30 years, and it's just like gold. Gold is a barometer of people's psychological feelings. Yes, it's a store of value, but you only go to it as a store of value in times when you feel somewhat uncertain. And that uncertainty can come from many places. But as I've said to people, I said, I've been neutral to bullish gold, Anthony, as you know. I will turn bearish when the short interest rate, or, we can use not the 2-year, but the Fed funds rate, the 90-day T-bill rate, when that goes to a premium over inflation, so that if I buy a T-bill at 2.5% and inflation's 2%, I'm getting a 50% real yield. That will be a headwind for gold, as it will for other things. But that's what I'm looking for. So the long end of the market really does not move the gold market. You get these people on TV who are, they got to tell some story, and they say, well, the 10-year yields are higher. That's not what affects, first of all, it very rarely does it affect the stock market per se. It's really, you're seeing the flattening of that curve, which is more dramatic because it's showing the short end of the curve is tightening, and the Fed is actually getting a little tight. They're not tight enough yet because, let's say the Fed funds rate is 1.5, the inflation rate is 1.7, 1.8. Some people will argue, of course, higher. You have a negative real yield. Negative real yields push all asset prices higher. That's just a fact throughout time, because as long as the cash that I'm holding or the short-dated deposits that I'm holding are really yielding a negative return, well, I'm going to search for other things besides cash. Cash really historically needs to return 1% real yield. So we should really be at 3% right now. And we're not near close. And I think that's part of the dollar story, by the way, too. That people are a little bit nervous that with all this new debt coming on and everything around it and real yields still being negative, there's not a whole lot of reason to park your money in dollar. Yeah, you may buy some dollar assets, but not to sit in cash dollars. It just doesn't make sense. So don't be confused about it. The gold is, people are going, well, why is the gold here? Because we know, because if we go back 3 or 4 years, we were on the risk-on, risk-off parity, the paradigm. That's been broken because gold and the equities have rallied together. How can that happen? There are positions out there that are enormous, and that's where we'll get to by the end of this show. But don't be perplexed by it. It's actually holding in there pretty well, and now it's going to be a guess as to what the new Fed chairman, which route he's going to take her.
I want to talk about one of your latest tweets, and you said, if you see someone saying printing money did cause huge inflation, but it was asset inflation, you can safely disregard all of their macro analysis. I started laughing out loud when I read this because I'm like, that's me. I put a tweet out there saying that, the Fed has found a way to create inflation, and I put a picture of the S&P 500 chart. So then I went to your blog, and then I started to read because I'm like, okay, obviously Mark knows a lot more about macro than I do. I don't claim to know anything. It's just what was one of the things that I have noticed. The Fed started QE. And, printing money and, stock market has gone up. You can't kind of disregard that correlation. So I just, once again, as a non-macro guy, I said that. So are we wrong, Mark? Explain to us why we are wrong in thinking that the Fed has created asset bubbles in stocks. And in some areas, I think they've created real estate bubbles too.
Yeah, okay. So one parenthesis before we get there, I want to say about the risk management stuff we were talking about just a second ago. I manage in 2 styles. I have a trading style and an investment style. And it's in the trading style where you really, like as you were saying, you really have to push it when you're seeing it because you make money in batches. And the longer your investment horizon, the more you're relying on your hit ratio and the less you're relying on strict risk management frameworks. But I wanted to say, we can come back to that later if you like, but I wanted to be clear on that. Now, when it comes to the Fed and bubbles, I think it's really kind of counterintuitive for a lot of people, but I think that people confuse liquidity with credit. The Fed, people think the Fed has been pumping all this money into the stock market, but the money doesn't go into the stock market. It's in excess reserves, and there's a reason we call them excess. They're not being used. They're not needed, right? So the Fed basically lowered interest rates as much as it could because we had a big credit bubble, and obviously after a big credit bubble, you need low interest rates so that people can work through their households and financial entities and everybody. We can work our way through the debt burden that we built up for ourselves, right? It just takes a while to come back from that when it's an overhang. So when they lowered rates, it wasn't enough. So they decided, well, let's push low end rates down further by buying bonds, and this was what they eventually was called quantitative easing. But functionally, what it really did was, it was like the old days when the bankers would stack money in the windows to show the depositors that they were solvent, right? To quell the runs on the bank, they would stack money in the window. I don't know if you've ever heard those old stories, but that's what the Fed was basically doing. It was a big confidence shot. The money didn't go anywhere, but by injecting all this liquidity into the reserve system, not into the economy, not into the markets, but into the reserve system, right? It gave everybody confidence that, hey, okay, we're not going to have a banking crisis. And it was a way to short circuit the negative spiral that sentiment was in at that time. So the banks don't lend anymore the way they used to. They lend based on collateral. So what creates credit is not how much base money the Fed is pumping into into reserves, right? It's really about credit and the banks extending credit and people taking credit from banks, and that has very little to do with the Fed directly. It has to do with risk appetite, right? So this is why we didn't have rates were at zero forever, and we didn't have loan growth. It wasn't about the price of money. It's because people were still scared. And it's for the same reason we had rates at 5.25% in 2005 and 2006, but people were borrowing like crazy. Why? Because when you think you're going to make 200% over the next 5 years, 3% and 6% looks like the same number to you. You just don't care. So people have this idea that the Fed is, and these are typically guys who don't understand the mechanics of monetary policy well. Fed puts this money in there to kind of calm the system down, to make sure that all the banks are going to have resources with which to meet their obligations to each other in the reserve system, right? But the banks were just selling their bonds and now they're holding cash. It's not a big deal. They may go replace it with other bonds. They may not, but they're probably not going to go out and buy a bunch of stocks with it, right? Because banks don't have that mandate to buy a bunch of stocks. So people have this idea that when the Fed, it's all fungible and it has to go somewhere. Those ideas are wrong. The reserves in the Fed system, it's a closed system. That money doesn't leave unless the banks demand physical currency, unless a lot more physical currency, which typically doesn't happen. So it's kind of just a misconception that people have about how this thing works. Base money is a small share of the overall money supply. And whether the Fed is making it expand or contract, it has a signaling effect. It has a psychological effect, but that money doesn't really get into anywhere. So the way you want to look at it is the Fed injected all this money, short-circuited the negative spiral, people calmed down, and little by little started taking risk again. And as they took risk, and the risk didn't come from the Fed's money, the Fed came from the money that we had put on the sidelines when we sold out in the panic, right? It was us putting the money back in. It doesn't come from the Fed. Now, the two paths are going to look like they coincide, right? Because the Fed is trying to ease financial conditions as the market is recovering, right? But we've seen over the past couple of years that the Fed has stopped increasing. The last few years, Fed has stopped increasing their balance sheet. They've increased rates significantly, a fair amount, and no problem. Now everyone says, well, in Bangladesh, they're printing money and it's all fungible, or Japan or Europe or whatever. And it has a little bit of an effect on our long-term yields, but that money's not coming into the stock market either. It's giving people confidence. So, like I said, you can look at times in history. We've had, the bubble in the dot-com bubble. It happened at very high interest rates. Remember the S&L crisis? You're probably too young, but you probably heard about it. The S&L crisis was overlending. It happened at much higher rates. So I think the two, if I could boil down the two things that people continuously get wrong, is thinking that the Fed base money is dominant and influence and drives the money supply is one. It's not. It's a small share of the money supply. The bulk of the money supply is decided by whether a bank wants to run at 3 times leverage or 10 times leverage, right? And that's really it. And then the second misconception that people have is it's all about the price of money. It's not about price of money matters, but it matters a lot less than people think. And as I said, people in 2006 that was the most aggressive year of borrowing in the housing crisis, and Fed funds was at 5.25%. Right? Why? Because they were greedy. Greed trumps the price of money. Obviously, it's different if you're talking about 15 or 20% interest rates, but interest rates within a reasonable range matter much, much less than people's risk appetite. Do they feel secure in their job? Do they see people around them making money? The banks are looking around. Do we have to compete with other people? These are the factors that push people to take risk much more than the price of money. And then the Fed's role in the overall money supply is much, much smaller than people believe.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. Now I want to move on and talk a little bit about Bitcoin futures. Ever since they've been launched, I've been waiting to speak with some of the spot exchanges to see how this has impacted their business. So Dave, how has the launch of Bitcoin futures impacted Kraken and spot exchanges?
Sure. Yeah, for this particular topic, it might be worthwhile to take just a brief step back and kind of, discuss the in many ways the purpose of the futures, right? I mean, if we think about the kind of the hedge that they offer, and then we think about the Bitcoin or cryptocurrency ecosystem and what entities within the ecosystem might have a need for this type of hedge. From an actual kind of running a business standpoint or other market drivers, right? I mean, typically in the traditional financial markets, you'll see this where XYZ large corporation has some inflows of revenue in one currency. I'll make it up, the Japanese yen, and they have costs denominated in another currency, for example, the U.S. dollar, and they'll enter into a future contract in order to effectively align those two cash flows in different currencies and minimize their risk. So I think the first question is, do we see the need for something similar in the Bitcoin cryptocurrency ecosystem right now? And I think the answer is yes, but not in a significant way just yet. There are some businesses out there that may have the characteristic that kind of lend itself to the example I just described. Perhaps Bitcoin miners might be the most prominent example. But in many ways, I think the ecosystem is at a point where a lot of those use cases are. We're going to see many more over the coming 5 years than we see today. And so, from that standpoint, what are the other benefits of the future in the near term if that kind of business market hedge is maybe not the most prominent use case? And one particular use case is Well, a lot of individuals, traders, funds and so forth might be interested in exposure to the Bitcoin price, but are much more comfortable, kind of using one of their existing, platforms to do so. For example, the CME or CBOE and what have you. And so we expect there are some entities out there that are, have simply chosen to trade the futures for that reason. What does it mean for spot exchanges? Well, such as Kraken. Well, I mean, generally, we view all of these innovations in the ecosystem as positive, right? I mean, there's the number of innovations, the number of new technologies, the number of new financial products needed to really continue to build out and grow this ecosystem and ensure its health and continued success and growth is just, it's almost countless, right? So there are many, many various different things that we need to see come to fruition. And, I think having, futures from established, some of the most established financial markets, businesses out there, CME and CBOE are positive things for the industry. And we typically view anything that's positive for the overall industry as, positive for Kraken, right? So we're very, very much, focused on kind of delivering what we need to deliver ahead of us. Like I said, our challenges are focused on just kind of continuing to scale the business and meet the demand. And, we view any of these, kind of new introductions of new products and so forth as positives. And, no doubt the growth and addition of these things will kind of further benefit the ecosystem and ideally further benefit our clients and in turn kind of, improves the overall industry for ourselves.
You post a lot of quotes on Twitter where you talk about why traders fail. What I'm curious about is what do you think are the most common reasons that traders do fail? And I think even more importantly, how do you think that they can fix these issues?
Okay, so I would say there is a few reasons why traders fail. Maybe I can share a few with you. Number one is I would say, for me personally, I feel that wrong expectations, because even though now we are in the information age where information is readily available, there's a lot of conflicting information out there. Like for example, you have traders thinking that hey, how much do I need to trade for a living? Some says hey, maybe $5,000 is enough. Some say no, you need 10,000. Some say no, you need 100,000. So this is where traders just do not know what is real and what is not. So I think first and foremost is managing the expectations to know that trading is a business. When you set up a business, say a mom and pop shop down the street, selling F&B, food and beverage, a restaurant or something like that, you don't expect to make money in the first year or even the first 2 or 3 years, right? You are pretty much, investing that time, effort and capital to kind of, set up the business, buy the equipment and see, the first 6 months, how the crowd is coming in. If it's not coming, maybe you have to, spend more on advertising. Maybe, the location isn't too good, you may want to shift elsewhere, So basically your first few years, you're basically investing and not expecting a return. And I would say trading should be approached in a similar manner where you don't expect to make money next month or the next 6 months if you're new to trading. You should give it some time to kind of, spend time to develop that skill. And then from then on, once you kind of have the framework and foundation that is set for yourself, and only then can you look to scale up your trading later on. So I would say the first few years is more about setting up your business, right? Investing the time and effort into it instead of, trying to, take a 5,000 account and turn it into $1 million within the 6, 12 or 18 months. That is I wouldn't say it's not possible because obviously people have done it, but the odds of you doing it is very, very slim. If not, you'll probably risk, blowing up a few accounts along the way. So yeah, I would say the first reason why traders fail is because they just can't manage their expectations correct because there's just so much noise out there, based on social media, and whatnot. So yeah, that is one of the reasons why traders fail. A second reason that I can think of is I'm also guilty myself is that it's trading is not like 1 + 1 = 2. Trading is more of like 1 + 1. 30% of the time it could be 2. 70% of the time it could be 2.5. Right. So there's really no fixed black and white answer to it. So where I think I spend a lot of time going around in circles is just jumping from one system to the next because I didn't understand that you need to be consistent in your actions before you can get a consistent set of results. So I think what most traders face is that, I try a new strategy, 3 or 4 trades you make money, the next 4 or 5 trades I lose money, I pretty much declare that it doesn't work. Let me look for another thing, another strategy that could work out. And you start this entire cycle all over again. And before you know it, right, years have passed and you pretty much have not really, accomplished anything that you hope to set out in the first place.
You mentioned intelligence gatherings, and I know that you are a big proponent of social trading. Why is that? Why are you such a big proponent of social trading and getting people together for these intelligence gatherings?
So, I would say as a young guy, and I don't know how you were, but, before you're humbled earlier in your career, you had a pretty strong ego. And I would say that for the most part, I would follow or listen or read other people's work more with an eye of that they might be a good contrarian indicator, or people were mainly, because most failed, good to fade. And later on, and I really delved into it at FX Street, they started a project I co-created called LAR, the Log Analysis Room. And the thesis was that we would attract great traders that would want to share their work, and that we would develop a community to support people. There are a lot of Wild West chat rooms where there are people, I have a few rules. You don't root for anyone else's failures, to rationalize your own, and respect the guests that I bring in, that I interview, because they're giving their time, even though they might pick up some business being there. But it's not a theory, because for years I did it, attracted great traders that had very good hit rates. And I could walk into a session, as I still do. I don't see things every day. I miss trades every day. But we only have 2 eyes. And after a while, when you see through screenshots, links that people provide, what their work is saying, the different types of methodologies that are used, that you could see things that with your own 2 eyes, before you got into that community setting, you wouldn't have even paid attention to. There's value in collaborating with people, especially, I say to people, Anthony, surround yourself with traders better than you. And that way you will rise to their level and you're going to learn. Also in a community setting, it's a lonely business, especially if you're, doing it. I don't care if you have an ocean view and you're doing it in your room. A lot of people have giving natures. And really, when you think about it, what good is anything until it is shared with another? So there are a lot of traders that like to pay it forward. Similarly to like what Richard Dennis did, and there are many people that want to help people avoid the landmines that they have activated, and help them along the way, because they know they have empathy for people that are just starting off and know how tough of a business it is. In fact, after I became a Series 3 broker, a veteran broker pulled me aside, Anthony, and said, "Kid, this is a tough way to make an easy buck." And he was exactly correct. So I'm a big believer in the community setup. You do need a good moderator or facilitator, because the atmosphere in the room is very important to keep it positive. You don't want any people in there that are trying to be disruptive, destructive. You could ban or knock off people in a room. And I really think the moderator, the facilitator, sets the tone for the room. And it's also something that I really enjoy. You do, people have made friends. People have gotten married. There's an aspect to a community that a lot of people don't even have in their own neighborhoods anymore. I remember where I grew up, or a place I lived in California where I knew everyone on my street. Well, a lot of people don't even know their neighbors nowadays in this setting. So I do think that a supportive and accountable environment, surrounded by traders that have a higher level of competency, hit rates, money management, methodology, is a great place for beginning and advanced traders to be. Because as an advanced trader, if you're not sharing your work, you're not crystallizing your views. I have much more conviction after I talk about something or show something than maybe it's NLP, than if I just think about it in my thoughts. It's kind of like writing something down. And you only really want to show your best stuff. So I think it even makes successful traders more successful, being in a good community.
So I want to move on a little bit here, Michael, and I want to talk about this deal between Coinbase's GDAX and TT. It's a first of its kind. And as I said at the beginning of the show, it's bridging the gap between futures traders and cryptocurrency traders. And there's a lot of reasons why I think this is important. But one thing that I think that sticks out the most is something that I mentioned to Rick Lane back in October at FIA and once again in November at JFLC, is having Bitcoin next to Bitcoin futures on the same platform. I don't know of any other company that is doing that. I believe you guys are going to be the first to do it. Of course, proprietary softwares can create that if they want to, but on the commercial side, I believe you guys are the first to be able to do this. So I think that this is very exciting for both crypto and futures traders. Michael, talk to us about the benefits to having futures and the underlying side by side on the same screen.
Well, I think having TT involved in the cryptocurrency world is an important step for that industry, because with it, TT brings a strong reputation. We bring a big professional customer base with us. This is a customer base that we believe has interest in trading this asset class, and to be able to do that on one login and to be able to view the markets all on the same screen. I think that's going to open up a lot of interest from futures traders to get into trading crypto, such as trading the basis between the spread between the cash and the futures. I think that TT helps bring a stamp of approval into crypto trading for some of them. A lot of futures traders were a little hesitant, maybe even afraid to get involved into trading crypto cash. So we can help educate, we can help get them started. Similarly, hopefully it also bridges the opposite way, which is bringing crypto traders over into the futures market. And the irony there is a lot of the crypto spot traders are deathly afraid of the unknown of getting involved and opening up futures accounts. So with a little bit of education on both sides, I think they'll both realize that the markets are maybe more similar than they realize, and they're great to trade between each other. And TT can bring some automated trading tools to help ease that process, so you don't just have to be click trading. You can, for example, just set a differential between the cash and the futures and have an automated program that can either be making markets in one to hedge in the other, or just waiting for an opportunity where certain prices are available, and it could send orders into the market to accomplish your objective.
But what I want to know is, on a real busy day like we saw last week, when many markets that you could be following could be hitting moving averages that you're watching, stops could be getting hit, all of a sudden new positions could be getting triggered. We talked about how you're manually executing all of these positions, but are you using any automation to say, hey, this hit a 200-day moving average, all of a sudden this is getting stopped out, but now, hey, we have a new opportunity here? That's a lot to take in all at once when you're trading as many markets as you are. So I'm wondering, what do you do during those times? Because I'm also thinking, hey, you also now have to allocate a different dollar amount because maybe you had some losses that have now come in. So your account size is different. How are you managing to know how much you're going to put towards a new opportunity? So talk to us about that process of executing when you may have a handful or more of markets that you're about to enter in.
Those are some pretty good questions. The first thing that I do is my my risk-based position sizing and my risk per position is predetermined. So the standard format that I use is I max out stocks at single stocks at 50 basis points of risk, and I max out ETFs at 1% of risk. So the maximum exposure, if I buy Google tomorrow, the maximum exposure that I can have is 50 basis points of risk versus my equity. If I buy the ETF, I can have 1% of risk. So that tells me exactly how much risk I can take in the position. And then what I use for position sizing is ATR. So I use different variables of average true range in the different programs to size the account. So if I get a signal in Google and I know that I'm going to use a 2 ATR stop and I know that I'm going to risk 50 basis points in the trade, then it's a 5-second calculation to determine what's 2 ATR from my stop price, what's 50 basis points of risk, and this is how much I can buy. So the position sizing is pretty simple. That's a 5-second calculation. As far as how do I know when like last week, so last week everything was a buy, and we all know that. So on Friday when the S&P, and you probably saw me on Twitter because sometimes I'm not as quiet as I should be, but on that Friday when the S&P was coming down to the 200-day moving average, I was pretty vocal about saying, here's what I'm looking at. I'm looking at the 200-day moving average because that's my signal. And if I get what I'm looking for, I'm going to put some money to work. So basically what I did was when the S&P, when it price tested the 200-day for the third time, I put some money to work, but I didn't put it into the S&P. What I did was I put it into either the highest relative strength stocks that were on my screen or the ones that scored the best in my program. But I already knew. I spent a lot of time that week, and I prioritized. So I knew that once I got the signal, here's where I was going number 1, here's where I was going number 2, here's where I was going number 3. And basically what I looked to do was I put the absolute strongest stocks and ETFs in my account that I could, in preparation for that if I got it right and if I didn't get stopped out, that these names should outperform on the upside, which is exactly what they did.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.